Valuations are at record highs however you measure it, on a price earnings basis, price to book, market cap, dividend yield, CAPE, whatever. Stocks are now more expensive than they have been in a very, very long time. If this was a source of entertainment for you, I'm just sorry for you. Investors have borrowed record amounts of money in order to invest in the stock market at the moment, and that's frequently a harbinger of bad times ahead. Sorry if you're British or Irish. Number two, way more comfortable. All of this. I ran a correlation analysis on the S&P 500 and the US dollar over the past year and found that there's a very strong negative relationship between those two things. Hi everybody, and welcome back to Capital Rev. I hope you are as glad to see me as I am to be recording this video. Before we get into it though, a little bit of housekeeping. I think I need you to subscribe if you're not already subscribed. You need to press the bell icon. There's a whole host of buttons apparently that you need to press at this point. That's what I'm told to tell you. So please, if you could go ahead and press all of the buttons. Thank you. Okay, let's get into it. Today I want to talk about why I'm selling off most of my stocks, most of my American stocks, because I think the US market, specifically the S&P 500, is heading for troubled waters. And I thought I'd share those thoughts with you, and I'm looking for feedback from you. So let's get into it. Okay, first and most obvious, valuations are at record highs however you measure it, on a price earnings basis, price to book, market cap, dividend yield, CAPE, whatever. Stocks are now more expensive than they have been in a very, very long time. Depending on how you measure it, they're the most expensive they've ever been. One of the things I like to do when I analyze a stock is actually look at the assumptions embedded in price at the moment, right? So if you take a standard finance formula and you isolate the G, which is the growth variable in that formula, you can sort of work out what the market is assuming about the future of this company. And so if the market is assuming a very, very rosy, optimistic forecast, that's a very bad sign, because at some point rosy forecasts break down, and that's when the stock gets taken out behind the woodshed and shot. And so you don't want to be an investor in a company that's excessively optimistically priced. And at the moment, applying that sort of methodology to the whole S&P 500, the market seems to be assuming right now that the S&P's cash flows are going to be growing at between 9.3 and 9.5% in perpetuity, which is ridiculous because, as we know, as good investors, corporate profits can only grow over time, over the long term, at the rate of economic growth. So the market is massively, massively optimistic at the moment, and I think that's a very, very bad sign. I'm going to post a bunch of images, so you won't actually have to see all of this while I'm talking about it, so you'll have some pretty pictures to look at. But however you measure it, the S&P 500 is morbidly, well, I don't want to say morbidly expensive. Actually, I do want to say it's morbidly expensive. So there it is. That's number one. Number two, sorry if you're British or Irish. Number two, way more comfortable, is obviously related to valuations, is margin debt. So investors have borrowed record amounts of money in order to invest in the stock market at the moment, and that's frequently a harbinger of bad times ahead. So it's not a great timing tool because margin debt's been growing at a very rapid pace over the last little while, but it's usually a very, very bad sign when everybody's plowed into the stock market and has borrowed money in order to invest even more, right? Because it's a double-edged sword, obviously. What's great on the way up, right? So when you borrow money and assets just keep rising in price, that's wonderful because your return on equity in that case is fantastic. But if prices start to drop, you actually are forced to sell along with everybody else who's forced to sell, and that causes markets to drop really, really fast. So that's a party, well, I want to leave the party before it gets too crazy, before the bikers show up and start destroying things. So I'm out, and margin debt's one of the reasons why. The third reason holds open the possibility that the market actually isn't that overpriced, right? So consider something like the price earnings multiple. It is a fraction, right? So it's price over earnings. And price may look morbidly bad right now relative to earnings, but if we assume that earnings are going to be growing rapidly over the next little while, maybe price actually makes sense. And so that sort of may sort of counter the argument that the market's overpriced. So let's look at what the source of earnings are. And in the United States, it's a consumer-driven economy, so the consumer is the biggest source of economic growth. So let's see what's going on with the consumer in the United States, shall we? Okay, so I think there are two things to consider in this economy at the moment, this consumer-driven economy. First, unemployment is back to 2014 levels. So we're at 6.2% unemployment in the United States at the moment. That probably understates the severity of it. A large number, I think it's 38% of Americans, have said that the pandemic has impacted their financial lives in a way that they haven't yet recovered from. And some smaller percentage, I forget what the number is, say that they will never recover. That's the first thing. The second thing, everybody's talking about these stimulus checks as being a source of great economic demand. But when you actually go through the surveys and look at what people are planning on doing with the money, it's actually an indication that they're not actually that optimistic as consumers. The biggest is they're going to save, they're going to buy food, they're going to knock down credit card debt and so on. And if people were optimistic, they would not be doing these more financially prudent things with this stimulus money. They'd be, buying electronics, they'd be going on vacation with it and so on. But they're actually hunkering down with the stimulus checks that they're getting, which to my mind is a sign that they are actually not that optimistic about the future. And I think they know best, actually. They know much more than some Wall Street analysts what's going on in the economy. So I'm going to listen to the signals from American consumers because they're generally smarter than Wall Street. The fourth reason why I'm pessimistic about stocks at the moment is the fact that markets overreact. They overreact on the upside and they overreact on the downside. And so it may have been an overreaction last year in March of 2020 when the market dropped so precipitously. And the market since then, since that slough of despond was reached at the end of March last year, has returned about 76% since then, right? So that's the largest 12-month return since, I think 1936, I want to say, the mid-1930s anyway. And so what goes up must come down, right? So when markets overreact on the downside, they tend to bounce back. And when they overreact on the upside, they tend to lose steam and come down. So just the very fact of overreaction is another reason that's made me nervous about owning stocks, which is causing me to walk away at the moment. Okay, so the fifth and the final reason why I'm avoiding US stocks at the moment is the growing strength of the US dollar as we leave March of 2021. I ran a correlation analysis on the S&P 500 and the US dollar over the past year and found that there's a very strong negative relationship between those two things. I think the R value is something like negative 0.94. So as the S&P 500 goes up, the US dollar goes down. And over time, that correlation is not as tight because it's not as clear that the US dollar's rise is bad for stocks. But at the moment, there seems to be a very, very tight negative relationship between these two things. And because the US dollar is so massively oversold, and because it is still the reserve currency in the world and it is demanded so much by the world and is bid so heavily and is so massively shorted, that all says to me it's a scary, scary time. And so that's one more reason why I want to avoid stocks at the moment, right? So I think generally speaking, the overarching theme here is that preservation of capital is critically important, right? So the more you lose, the better you have to do in future to get back just to the starting line. So if you lose 50% in year one, you have to make 100% in year two just to get back to the starting line. So losses really, really hurt. So for my part, I would rather avoid loss and maybe give up on some future upside from here, a little bit of upside from here. But I think what the market giveth, the market taketh awayeth. And so it's eventually going to drop. So that's why, in a nutshell, why I'm avoiding stocks into 2021. Okay, so that about does her, that about wraps her up. Going into Q2 of 2021, I am avoiding stocks. I'm selling off most of my stuff, and that's what I'm doing. And so I'm keen to hear what you people think, because I think there's some wisdom in the crowds. If I'm missing something or if my argumentation is flawed, please do let me know in the comments and I'll respond. Maybe we can have a conversation about it. But I'm just talking about what I'm doing. I'm not soliciting a trade, or I'm not making a recommendation to you. Before you trade this or anything else, please reach out to a financial advisor. The purpose of this video, such as it is for informational and entertainment purposes. So I hope you found it informative, if it was of informational value to you, that's good. If this was a source of entertainment for you, again, I'm just sorry for you. There's much better sources of entertainment out there than all of this. So if I am your source of entertainment, seek other sources of entertainment, because there's much better stuff out there. I'll leave links maybe in the description. I'll also leave links to my sources for this analysis. That's about it. See you next time. Birds come